by the resilience and the adaptability of the sector. And I have to say a big thank you to all of you for all the amazing work that you're doing, and how I was saying to Kathy earlier, you know, you're made for this, and everyone's risen to the challenge, and it's so incredible to see. And whilst we see a number of businesses closing, I haven't seen any, or in my personal experience, non-profit organizations closing over this time, although I'm sure there are one or two. But I think just by nature of the people involved, often the work just continues, even with very little means. Or alternatively, some organizations have also found themselves in a position where their activities are very much in demand, and they're seeing more funding, and there's more work to be done. And from my side as well, I work often with donors and help them set up foundations to formalize their giving. And not since before 2008 have I seen so many donors come forward with requests to actually set up foundations. So these are all people who've been giving themselves anyway directly to organizations, but now actually wanting to take the next step. So I think it's been such an interesting dynamic. It's brought out so many things in the sector and in donors and the organizations themselves. And I just wanted to say a very, very big thank you, and just to praise you for the resilience and the adaptability that I've seen. So today we're going to have a whole range of participants in this session. So some people are going to have a very high level of knowledge, and other people are going to be, like I know just in some of the questions that have been put forward to me, I invited questions to those participants who signed up early, just to put forward any questions that they might want answered. And so it was quite clear from that too that some of the participants are going to be people who might not actually even yet have set up the nonprofit organization and are looking to do that. So it's quite difficult to pitch the level at, you know, something that's going to be appropriate for everyone. So I just ask the people to bear with me who've got very complex knowledge. There's always a nice refresher, and certain parts of it might be familiar to you, but it's always good to remind ourselves. And same for those who've got very little knowledge on this area. We all have to start somewhere, that they just bear with me as well on where we're dealing with the more complex issues. So what I've done is I've taken 10 questions, and I've used, it's things that have come up quite significantly and often during COVID, questions that have also come through as a result of that invitation that I sent out to put forward queries, and just questions that have come up in general practice. And although it's only 10 questions, you'll see that they actually cover quite a few areas, and they raise a few topics and things. And as mentioned, I can't cover too much because of the time constraints, but hopefully this will touch on things. And again, just for yourselves, you're not expected to walk away with knowing all the answers, but certainly just hopefully a few alarm bells ringing where you know that there's certain areas you might need to look at, or that if you do come across them in your day-to-day work in this space, that you need to investigate further. So I've just put the disclaimer up, and I think it's something that applies to all the talks for Think Good, but particularly here, in that I'm going to be discussing the legislation and the various rules, but every organization is different. And the smallest fact can actually change how the rule applies to your organization. So it's so important that you don't just take the rule as a given and that it applies exactly in the way I say for your organization. You do need to please take advice from a professional just in applying what the learnings are today to your organization and its specific facts, please. Okay, so towards a new horizon, I've briefly touched on this anyway. You know, we're working in extraordinary times. Sort of the more things change, the more things stay the same, I think, with tax, and that the tax doesn't really change, but the circumstances in which to which the tax is applied have certainly changed. So we all know we're fundraising differently. We might have investments that have kept us going. We had like a sustainability of funds in some way or another. So tax touches on so many different aspects of how we've been operating during this time. Have we been doing activities that we weren't normally doing? All of these kinds of questions. But the rules effectively, you know, they remain pretty constant. And there are a few situations and things that have come up specific to this COVID time, and I'll touch on those as well. So I wanted to start off with the back to basics, because today's talk is about PBO and Section 18A. So already we've got all these acronyms and these section numbers. What do they mean? And I see people who've been working in the sector for so many years still mixing up the acronyms and the various approvals and things, and that's absolutely okay. That's why we do these refreshers, just to remind ourselves how it all fits together. So my famous ice cream, for any of you who have attended our training, Kathy knows this one well, And I just love the way that it exemplifies how, you know, if we go to an ice cream shop and we order an ice cream, we can't just put our hands out and say, you know, please just put my vanilla ice cream with chocolate and cherry in my hands, because it's all going to trickle through. We need something, we need some kind of container, some kind of structure upon which that ice cream can sit so that we can actually enjoy it. And it's the same with a nonprofit organization. So you need a base, you need an entity or a structure. Those are all sort of quite formal legal words, but really just something that holds your organization. It is your foundation of your organization. And within this sector, it's generally a trust, a voluntary association, or a nonprofit company. So a trust, you've got a trust deed and your trustees. The voluntary association, you've got a constitution, and you've also got the fiduciary office bearers, I find, have got various names with a voluntary association. It can be it can be directors, it can be trustees, it can be, you know, just there's a whole range of terms. And a nonprofit company as well, you've got your directors of a nonprofit company. So you've got your entity, and so you are one of those three things. Then that entity goes off and it can get a number of approvals. And this is where all the jargon and the acronyms and things come in. So the first one is Public Benefit Organization Approval, or PBO status. So this is what I like to call your vanilla approval. So that's the vanilla ice cream there. Then you might also have, as an organization, the cherry on top, which is your Section 18A approval. And that's also got to do with tax and is available from SARS, like your PBO organization approval is too. Then another term that we get sort of always mentioned in the sector is your NPO registration, your NPO status. Now, we can all call ourselves nonprofit organizations, but you can go and formally register as a nonprofit organization. And I just want to emphasize that this has nothing to do with tax. This is specifically to do with governance and accountability. So you've got your base, then you've got the approval potentially as a PBO and potentially as an 18A, and you could also possibly be registered as a nonprofit organization. I just want to emphasize that those, in fact, all of these aren't automatic. They're things that you have to do in order to set up an entity or to get these approvals. You need to get the approvals and the registration specifically from certain government departments. So there's just a summary of it. I've included it more specifically. So when you've got your notes, you've got that, when you get a copy of the presentation, you've got this for you. And just to emphasize again that your PBO and your Section 18A approval comes from SARS. NPO is nothing. And I say this, and I know I'm repeating it, but often in our training, Kathy and I will ask people sort of what approvals have you got? And they'll say, no, I'm an NPO, and almost assuming that you automatically get the tax approvals. Or again, sort of, how are you set up? And they say, no, I'm an NPO. And it's the emphasis that there's something behind your NPO. You know, there is that structure, there is that ice cream cone, and we all have that if we've got an organization. So I had said to you that Section 18A approval is not something that, it's the cherry on top. It's not something that all organizations enjoy. And how do you know as an organization if you're entitled to Section 18A approval and can apply for it? So Section 18A approval is basically an approval which is an added benefit, and I'm going to go through the benefits of the donor and the organization, but it makes you more attractive to donors because donors can actually pay less tax by making donations to your organization if your organization has got Section 18A approval. So these are the broad categories of activities that if an organization carries these on, they could likely qualify for Section 18A approval. And it's not just that you can say, oh, I'm sure our sort of activities that we do they would fall under welfare and humanitarian. In the Income Tax Act, there's specific lists of specific activities. So you need to be able to tick the boxes that you're doing one or more of those specific activities that are listed in that act to show that you would possibly qualify for Section 18A approval. So you can see welfare and humanitarian, healthcare, education and development, conservation, environment and animal welfare, but not all of those activities, and land and housing, again, not all. And just out of interest, these activities have got added benefits for donors because they're areas that government has prioritized, that they'd like to actually attract funding to, with government realizing that they can't get to all the work that needs to be done. They need the organizations, and they'd like to encourage funding in these particular areas. So with organizations carrying on activities listed here might not qualify for Section 18A approval, or their activities might not qualify if those activities are related to religion, belief, and philosophy. Cultural, this includes youth development, sport, research, and consumer rights as well. Now, if, for example, a church applies for PBO status, they could get PBO status. They might not get Section 18A, or they wouldn't get Section 18A status if all their organization does is promote Christianity, as an example. But if they've got a feeding scheme of some sort, or if on the cultural side, it's an opera or ballet organization that does sort of outreach type of programs, then those programs themselves might qualify. So just because your organization itself just has a sort of what we'll call the vanilla PBO approval, it doesn't mean that you have absolutely no activities which would qualify you to be able to offer Section 18A approval or Section 18A benefits to your donors. So how do you know which approvals you have got? This is the second question, and for which activities? And this is going to come up a lot because SARS used to be quite black and white things, and pretty much you either had PBO status or you had PBO and 18A approval for everything you did. But over the years, that's become a lot more mixed, and SARS is a lot more open to giving organizations approval for only some of the activities they do for Section 18A purposes. So it's no longer a blanket, no, you don't do any, if you either do only 18A activities, otherwise we don't give you 18A. It's now that, okay, show us which activities of yours are ones that qualify for Section 18A approvals, and we can possibly approve you for those. Just those activities will get that 18A approval. So how do you find out which approvals you have? Well, it's your SARS letter. So as I said, none of these approvals are automatic. You would apply to SARS, have a very clear description of what your activities are, tick the boxes of all the activities that you're carrying on that you think qualify for the various approvals, and then it's up to SARS whether or not to approve your organization. And your letter that you get from SARS is generally, it's a letter. So it's not like, I think people are looking for certificates or things sometimes, or something that is a little bit more recently dated, but it might be that you got your PBO approval from SARS in 2000 when the legislation first came out. And that is actually your current approval letter still. Unless you've heard to the contrary from SARS, saying that your approval is for some reason being withdrawn, then that is your letter still. And you might have two letters as well. It might be, again, that you got PBO approval, and then you realize, hey, wait, there are some of our activities that qualify for Section 18A approval. And then you might have a second letter which covers that. So it's quite important to know, whether you have got a Section 18A approval and which activities you've actually got them for, so that you don't fall foul of passing on these benefits to your donors to the detriment of your organization. So not only are there ramifications from just a SARS perspective, where they could potentially take your approval away and also actually nullify some of the receipts that you give to your donors. There's a number of consequences you wouldn't want to happen. But it's also important from a relationship perspective with your donors. So a recent example I came across was a donor client of mine phoned and said, he made a 100,000 Rand donation to an organization, which is very generous from an individual in their personal capacity. But he said, it's been disallowed by SARS because this organization doesn't have Section 18A approval, and I've actually got the 18A receipt. And what had happened, it wasn't even the organization's fault, but what they'd done is they changed the nature of their entity. They had been in a voluntary association, and they changed over into a non-profit company. It was the same organization, but SARS issued a different PBO number and didn't give them Section 18A approval for their new entity. And that is the bank account into which the client paid the donation. So he actually asked for the donation back, and he got that 100,000 Rand donation back from the organization. And I know that sounds pretty harsh, but he's an incredibly generous man. It's unbelievable sort of what a social conscience he has and how much he gives. But he's also a finance man, and he works out to the last sort of cent how much he can afford to give each year based on his tax saving and his tax deduction he's going to get from Section 18A. So he had made it very clearly on the assumption that he was going to get the Section 18A deduction. So it's very important that we follow the rules and we're very, very clear on what approvals we have. So for those people who are attending today who are thinking of starting an organization, and for those who've been in this for a long time and just want a nice refresher, what does that vanilla PBO approval mean for your organization? So PBO itself grants benefits to the organization and it grants benefits to the donor, whereas Section 18A approval, that cherry on top gives financial or tax benefits to the donor alone. But of course, you have that indirect benefit of that it's very attractive for donors to then benefit your organization. So there is an indirect spin-off for you, but it's not like they're direct tax consequences for your organization if you've got Section 18A approval. But for PBO itself, public benefit organization status, the sort of vanilla status, there are benefits for both the organization and the donor. So for the organization, I think, we talk about the tax exemption unit and we talk about tax exempt entities. It doesn't mean that if you've got PBO status that you've got absolutely no tax liability or there's no tax payable whatsoever. Generally speaking, a PBO can be completely tax exempt. But there are certain circumstances in which a PBO might pay tax, and those particularly relate as well to trading. So if you are involved in some income generation in order to generate further funds for your organization towards self-sustainability, which is a very good practice in any event, it might be that you have to pay some tax on that trading income, and it depends, and also the assets used in trading and the property used in trading. And by trading, even we're talking about rental properties as well here. But I always say to people, just because there's a little bit of tax payable doesn't mean that you mustn't do it. It's just you're still generating further funds. It just means that worst case scenario, you do have to pay a little bit of tax on that trading income or in respect of those assets. And it's still worth doing that. But otherwise, generally speaking, you can, as an organization, have sort of general tax exemption in that there's no income tax or capital gains tax, etc., to be paid by the organization if you're not involved in trading. And I also wanted to make the point as well, don't want to get into the detail, but certain trading is absolutely tax exempt anyway. So it depends on what kind of trading you're doing too. And you do have certain thresholds within which you're also completely tax exempt. So most organizations, certainly that I come across, don't end up paying tax. But you must just know that it isn't just a complete blanket tax exemption. Getting your PBO status doesn't mean that you don't have to pay other taxes like employees tax, skills development levy, or from paying workmen's compensation or unemployment insurance as well. And very important to bear in mind that you need to be registered as a taxpayer. The organization needs to be registered. This usually when you apply for your PBO status, as you lodge your application, you usually get registered at the same time automatically by SARS, but it's just very important that you check you are registered as a taxpayer, as an organization. And every year you've got to submit tax returns. I just want to sort of, to dispel that myth that there's no tax payable, there are no tax returns necessary, and there's no tax registration either. SARS uses that every year to assess, to continue to assess. Does this organization still qualify? Should we still have them approved? Should we reconsider, etc.? So those are the advantages of the organization of PBO status. Then for the donor, there are also some significant advantages. So one of the first ones is if you've got PBO status, then any donations made to your organization, no matter the size of the donation, will not attract donations tax in the hands of a donor. And for those of you who don't know, individuals can make donations of up to 100,000 Rand per tax year without attracting donations tax. But anything over and above that attracts donations tax at a rate of 20. And even if it's larger amounts, there's an even higher rate of tax when you reach a certain threshold too. So no donor is going to want to make significant donations to your organization if they're going to be hit by donations tax as well. Also, the beauty is if you're a PBO, then a donor can make any size donation to your organization and there'll be no donations tax consequences for that donor. Then there's also possibly no capital gains tax as well for the donors. And this is relevant where a donor donates a donation in kind to an organization that has some kind of a value. So maybe they donate a share portfolio to your organization rather than selling the shares first and donating the cash to you. If they've made a nice gain on that share portfolio, if they donate the share portfolio directly to your organization and you've got PBO status, then they won't pay any capital gains tax as they would have had they sold it and then given you the funds. And same with transfer duty, depending, on if it's an immovable property that's being transferred to a public benefit organization, it might be that there's no transfer duty payable as well by the donor. So this is just in a bit more of a sort of picture format for you, just to give you an example. So if a donor makes an 150,000 Rand, let's say, just cash donation to a public benefit organization, if you look on the right where it's this sort of rectangular box, there would be no donations tax in respect of that donation, although, as we said, up to 100,000 Rand would be free, as donations tax free, assuming that donor hadn't made any other donations that year. Also, possibly, if that 150,000 Rand donation was a share portfolio, there would be no capital gains tax. And if it was a property, there could possibly be no transfer duty. And there are a few other lesser taxes as well that are also savings there, potentially. From the side of the PBO, if we can look in the orange rectangle, there's, if the organization's got PBO status, the advantages just generally, not only in respect of this donation, are that there's limited tax exemption from income tax, CGT, transfer duty, and a whole range of other taxes. I've also just added in blue there that if that organization is also Section 18A approved, then not only does this donor not have to pay not have a liability for various taxes, but over and above that, they actually get a limited tax deduction, up to 10% of their taxable income, generally speaking, in respect of making that donation. So they're actually paying less tax by making that donation. So on to frequently asked question number 4. Our organization has got Section 18A approval, and can we issue a receipt to every donor? So I have heard people sort of mentioning about how a number of methods of issuing Section 18A receipts within the organization. Some have talked about a computer program that would just automatically churn these out, because sometimes they're a bit of a hassle to have to churn out. And then others say that no, well, they're just given to sort of pretty much someone who isn't responsible for finance or tax in the organization to just continue to give these out. And what is so important is that every single receipt that you issue is well thought through. So for those of you who are not aware, for your donor to be able to claim that Section 18A deduction in respect of a donation and to pay less tax, they need to receive a receipt called the Section 18A receipt, which has got a very specific format. And that receipt, they don't necessarily have to submit with their tax return, but they have to keep. And then if they're ever audited, then they would submit those returns as those receipts as proof. So you would need to, so donor, you don't have to, unless the donor asks, you don't have to issue a Section 18A receipt each time, but it is just very important that when you do issue a Section 18A receipt, someone does apply their mind to whether or not one should issue it in those circumstances. So so when do we issue a receipt? Well, it depends on which activity the donation will be used for. Do you have Section 18A approval for that? So, for example, Millie, I see you online here. Can I use you as a bit of an example with Scouts? They've got certain of their activities are Section 18A approved, if I can remember correctly. So now what Millie needs to do is she needs to make sure that if someone gives a donation to the organization and they would like a Section 18A receipt, she can only spend that money that she's issuing the 18A receipt for. She can only spend it on those activities that SARS have said have got 18A approval for Scouts. She can't spend it on anything else. That's where the organization runs into trouble. Even on the certificate, as I mentioned, it's got a very specific format, and there's an undertaking on the part of the organization too that says we undertake to spend this money on Section 18A approved activities. Also, SARS are becoming a bit stricter and stricter. I actually see they've just brought out a new tax amendment bill, and they mentioned the audit certificate. And this audit certificate has perplexed us practitioners in this area for many years, because it's not clear who issues this or where or how. But SARS is putting the onus on you as an organization to say every year, if you do both, if you do activities that are approved just as PBO activities and others, and only some that are approved with 18A, you need to actually submit an audit certificate which certifies that 18A or funds that you've given an 18A receipt for are only spent on activities that you have got Section 18A approval for. So that's very, very important. Also, just another slightly more practical issue too, but if you are a funding trust, so you get two types of, well, not even a trust. If you're a funding organization, that should just say organization, You get activities organizations and you get sort of funding organizations. So an activities organization would be like a Scouts or a St. Luke's Hospice, whereas a funding organization is more like a grant maker. And when you have got Section 18A approval as a funding organization, as soon as you issue a receipt, you actually, you tie up and restrict those funds so that they have to be spent within a certain time period. And what's nice, as we know as an organization, is to be able to have that freedom to decide when to spend the funds and not to be tied into a particular time period, particularly if there are any sort of capital projects that you're working towards. But I want to stress that this is only applicable, this time within which you must spend sort of funds for which you issued 18A receipts only applies to funding organizations or grant makers. It doesn't apply to the activities trusts like Scouts, who run the programs on the ground. Then it also depends very much on the type of donation as well. And we're going to go through 2 slides that specifically deal with which donations do not qualify for Section 18A receipts. And this is always an area where I think, people just by way of practice, that it applies to so many people, so many of these different scenarios, and people are often very unaware that we can't issue Section 18A receipts for these types of donations. So now we know that the world of fundraising has changed quite significantly. A lot of it's happening online. I attended 2 quizzes during lockdown for that. We're raising funds for charity. And so we had to pay a certain amount as a donation to enter the quiz, which was held online. And we basically, those organizations would not have been able to issue a Section 18A receipt for that amount that I paid to enter that quiz. And the general rule that follows through all the way here is that if you're going to get something in return, if there's some kind of quid pro quo, SARS, just using Latin terms, SARS doesn't see it as a bona fide donation. So they're saying you're getting something back. It's not really a donation. So you're getting some kind of benefit. And in those instances, you cannot, or you as the donor, cannot be issued with a Section 18A receipt. They don't see it as a sort of bona fide donation. So there you're getting the opportunity to take part in a quiz. So I'm sorry, it's not really strictly speaking a donation, so you can't get an 18A receipt. Same for those quizzes as well, or not only those quizzes, but certainly, I'm sure with all of us, I've been on social media, sadly, a lot during this period of lockdown, and I've seen all sorts of things, and so many organizations being innovative, where they're auctioning weekends away for when those could be used, or jewelry, for example, just as different ways to raise funds for an organization. So the person who donates that weekend away or who donates the jewelry cannot get a Section 18A receipt for the value of that donation, nor can the person who buys it on auction in that particular setting as well. Same with the prizes and sponsorships. Certainly the quizzes I did, there were lots of prizes. Again, the people and the companies giving those prizes and sponsorships can't get a Section 18A receipt for that, because again, they're getting marketing or some kind of exposure through this. School fees, school levies as well. Educational organizations can't issue Section 18A receipts for the payment of those. Again, someone's benefiting and receiving education through that. Raffle tickets. This one I think is potentially quite relevant here within our time of COVID, is the free rent and utilities provided by a lessor. I know many lessors have let their tenants off fully for the payment of their rent sometimes, giving them payment holidays or giving them reduced rental. If they had to ask you for a Section 18A receipt for the value of that rent that you would have paid, unfortunately you cannot provide that to them. Same with the payment of a debt owed. If an organization is struggling, they say, don't worry, this is one of the ways we'll help you, we'll pay that debt for you. One cannot give a Section 18A receipt for that. Tithing to a church too, the church cannot issue Section 18A receipts for that, and membership fees too, one cannot issue Section 18A receipts because you get the benefit of membership. So again, that's the common thread running through, that there's some kind of a benefit that comes through. Tithing is different. Tithing is, usually promotion of religion is not a Section 18A approved activity. Then services, this is a very important one, is you cannot issue a Section 18A receipt to a donor who has donated services to you. So this could apply to, and it's the obvious ones are your lawyer or maybe a plumber or an accountant saying, we're not going to charge you, but it would have cost you 30,000 Rand. So can you please issue a Section 18A receipt for that? But the less obvious ones and examples that have come up over time is allowing the leasing of a motor vehicle for free, or allowing people to stay in hotels for free, or designing a website, or providing free advertising in a magazine. So these things are less obvious examples, but they're seen as services rather than actual tangible donations. It's quite weird, I must say, just giving these talks virtually, because I can't see if you're all nodding or if anyone looks confused. So I'm just going to assume that you're all okay with everything, because I can only see 4 faces here on my screen. Okay, then moving on, frequently asked question number 5. So my organization has received a donation in kind. I think a lot of organizations have been receiving donations in kind, particularly feeding schemes. Over this particular time. What value do I insert on the Section 18A receipt? I mean, we've heard all sorts of stories where the value seems particularly inflated, or a donor says, oh, here's a till slip. This is exactly, you know, how much I would have sold it for in my shop. Or I'm giving you food that's expired, but this is how much it would have sort of cost. So can I have a Section 8? Yeah, can I have a Section 18A receipt for this? Now, whose duty is it to actually insert that value, and at what point do you actually just take the donor's word for it? And there are very, very clear rules set out in Section 18A, which set out how you determine the value of a donation in kind. And the general rule is it's got to be whatever is the lower of the cost to the donor or the market value of the item. There are also some rules in there for various types of assets, but the general rule is this. So whose responsibility is it to determine the value? And I would say that, you know, you can't be expected as an organization for every single donation to go and send in an independent auditor and do a due diligence to see exactly how much that costs. That's just not practical or reasonable. I think one has to take it at face value, but there are certain rules as well, in that, for example, a till slip, that sounds very much to me like market value. And there, in that instance, it would more likely be that you need to go back to the donor and say, well, what was the cost to you of the items, not what is the market value. There was also a question about VAT too. Is the donor submitted an invoice as proof of what the value of the items donated in kind were, and included VAT on that? So it should be without VAT. It should be the amount less VAT. Also, items that have got no resale value to the donor, for example, food past its sell-by date, should not be given any value whatsoever. So there's certain instances where, yes, you know, one does generally have to defer to the donor, and unless it looks glaringly like there's something wrong there, that you do need to maybe ask questions. And I know it's tricky from a relationship perspective, because we appreciate the donors and the donations made, but just point out to your donors that this could have a serious impact on your tax approvals and your tax registration, or your 18A and your PBO. And also for the donor itself, it might be that SARS actually, and I think that's actually quite a nice way of actually, you know, just dealing with the donors, saying, you know, it might actually mean that your receipt gets nullified anyway if SARS isn't happy with the value put in there, because that's the power that SARS does have if they're not happy with how Section 18A is being complied with by an organization. They can just nullify the organization's 18A receipts. Also, we've been asked in our training as well about invoices. And at first, you know, we were a bit confused as to why donors were asking for invoices and Section 18A receipts in respect of a donation. And in one scenario, it is just for sort of financial compliance within that organization. And they can't just make a donation without there being some kind of paper trail. So they ask the organization, please issue an invoice so that I can actually get my finance department at the company to pay this donation over to you. And I want a Section 18A receipt as well. Now that's fine, but provided that that invoice is very, very clear that it's not in respect of services that you are providing to the company, but it's very clear that it's in respect of a donation and should clearly refer to the word, the donation being made. So it is just literally a way for them to claim payment. But they cannot claim, you know, just a normal invoice as well as a Section 18A receipt, because then that would allow the company a double deduction. They get their deduction in terms of Section 18A, and then they can also claim a deduction as an expense on that invoice as well. Okay. So this next sort of three questions are questions that came up very, very often for me during the period of lockdown, where people were doing things that hadn't maybe been involved in doing sort of charitable nonprofit type activities before, but had seen the need and rose to the challenge and started, whether it was, just to give one example of someone I know who from her house was doing a feeding scheme and was buying the food herself, putting it together with friends, driving into different areas and distributing it herself. So a lot of people were getting involved in activities, and I think it brought out really one of the more beautiful sides of human nature. And then what happens inevitably is, some people have got the time and they're willing and able to do that, and then others want to support that. So then that person finds himself in a position of, oh, okay, well, I was just doing this with my own money. Now people are starting to give me more money, and people are giving me more and more and more money, and now I'm feeling a lot more responsible. It's going into my bank account, and people are starting to ask if I've got PBO and Section 18A approval. So the question is do you set up a separate entity, and can you just fundraise in your own name? So the simple answer is yes, you absolutely can go out and just fundraise in your own name. There used to be the Fundraising Act, which you needed to actually get a proper registration number before you could raise money. And I think we all used to see people holding tins many, many years ago, and there would always be a number, a sort of registration number to show that they were authorized to fundraise. Now with the Nonprofit Organizations Act, there is no requirement, but and certainly in extreme times like we've had in the past couple of months, there's been a need for people to perhaps fundraise in their own names. They haven't had an entity. So it's a question of, oh, am I just bogged down by red tape and then I don't actually do anything to make a difference? Or do I just go ahead and do it? And a lot of people just would go ahead and do it. And I think that's fine for extraordinary times. Of course, there are going to be people who are going to abuse that. But, for the people who are doing it sort of correctly and with best intentions, it did free them up to be able to do this very, very important work that they were doing. Now, whether those people go on to set up their own organization depends. So I think the first question is, it depends on their long-term intentions. So is this going to be a longer-term project, or is it something that over the next couple of months is going to whittle out as the economy hopefully gets back on its feet and there's less of a need? I mean, that would be an amazing reason for the work to no longer be required, that for it to wrap up, that it's no longer needed. But otherwise, I would say to those individuals, if you're not going to set up an organization, you're not going to do it for the long term, carry on what you're doing. But ideally, this was my advice, was actually go and partner with an existing established organization. And I'll run through that in the next question too. But there are a couple of reasons for you or any individual thinking about doing this work is in setting up a separate entity. And the first one is governance and accountability. So it's reputational risk. It's also just, the fact of no one likes to pay money, except in these extreme circumstances we've had, into an individual's banking account. It doesn't look good. It's a lot of responsibility on the individual receiving it. A lot can go wrong. You need to be able to account to your donors. You need to show exactly where every single cent went. And so ideally you want a separate entity, and the only way you can get a separate bank account really is by having a separate entity. Then also, the more and more people who make donations and the larger those donations get, people are going to start asking for, where are your various approvals? Have you got PBO status? I don't want to pay donations tax. Have you got 18A? I want my tax deduction. And of course, that has benefits for the person as well who's doing the activities, in that they also want those tax exemptions, and they also want to be able to attract donors by having Section 18A approval. Then another good reason is personal liability. We always want to create some kind of separation between the work we're doing and us in our personal capacity. If you're carrying on the work without an entity between you, then if something had to terribly go wrong and someone wanted to take action or legal action, it would be against you in your personal capacity. So you would want that separation, that a separate entity, and the entity being a separate ice cream cone, affords you, either a trust, an association, or a company. And then also you can only get NPO registration if you've got that ice cream cone or that entity. And this is something that we've all come across just through experience, that most donors, particularly when they're going to make a larger donation, or their government donors or corporate donors, will ask you for your NPO registration and your NPO certificate, registration certificate. So you can only get that with a separate entity. So Just to touch on this very sort of short-lived piece of legislation, which was interesting, the Disaster Management Tax Relief Act, which was brought out, which actually only applied for the period of the beginning of April until the end of July, so it's already past its sort of shelf life. But what SARS did is they said if you were a COVID relief organization, then providing relief in these circumstances specifically because of the pandemic, then you would be assumed to have public benefit organization status, and you would be assumed to have had Section 18A approval, just to enable you to attract donations as well. It was very, very short-lived. In any event, apparently the tax exemption unit was prioritizing any organization that was doing COVID-related work. They were actually putting straight to the front of the queue, and organizations were being approved in a matter of days, literally. So it's not like this legislation was absolutely essential, but if the TEU hadn't done that, it certainly would have been helpful. But it was a very sort of, it wasn't really known about, and it's, as I say, it had such a short little lifespan that it's already something historic and not something that, these things, you could have relied on it, but who knows how it would have actually been applied in practice. So for those people who've been fundraising in their own name, the realistic thing of having an organization set up in time to get PBO and Section 18A approval, it might have meant that they had to carry on fundraising in their own name through a little bit, or partnering with another organization. If they've got long-term intentions of carrying on the work, then absolutely, it is every reason to set up a separate entity. So this leads me to my next question, which is frequently asked question number 7. It's, I'm fundraising in my own name and donors are asking for Section 18A receipts and are concerned about donations tax. Can I borrow another organization's approval? And this doesn't only apply to those individuals, but it also applies to organizations who don't have Section 18A approval or who have been waiting for Section 18A approval, and a donor's insisting on an 18A receipt, and they say, oh, let me just chat to this sort of next door organization, maybe they'll receive it for me and pay it over to me. And the simple answer is you absolutely cannot borrow another organization's Section 18A approval, and you'd be crazy as an organization to lend it to another organization. But I know these have been very challenging times as well, and what you can do is, very importantly, substance over form. You can actually work with another organization, almost run like a program of theirs. And if they've got Section 18A approval, it would be a way of that organization getting in further donations as well, but channeled towards a particular program, which is the program that you are running. But it has to be genuine, it has to be real. It's that you're like almost a service provider to that other organization. It cannot just be like a bank account kind of arrangement. There's a very real risk of there being severe ramifications from a SARS perspective. And interestingly, just as an aside, someone contacted me and they were looking for an organization even to partner with, and they were told that the organization wanted a 25% share of any donations received. So that in itself, from an ethical perspective, was questionable. But when I thought about it, if they were genuinely going to be a program and they were going to be using resources of that organization that had 18A, then fair enough, there might be some costs attached. But if not, then it was just unconscionable, and in any event, not the right route to follow if it was just going to be a sort of bank account type of arrangement. So frequently asked question number 8. Another thing that came up in COVID is a number of organizations not being able to offer the services that they usually offer, and so then changing direction or using their facilities. And this is where I talk about the adaptability of the sector. It's an amazing thing to actually say, well, we can't do that, but we can do this, and this is what's needed right now. So we're doing different activities now, and it doesn't have to mean that you've changed your entire organization, but there's just sort of different programs now. For example, maybe you were a training facility and now you're using your premises to provide feeding schemes. So how does this all fit in, and is that okay? So first of all, we don't want to be donor-driven. Need-driven is absolutely fine, and I think that's what a lot of the changes were motivated by during this particular time. But it's a governance issue and it's a tax issue as well. So, if you are carrying on new activities, it's just very important to get your house in order. So as a company or as a trust or as an association with a constitution, you're actually set up in such a way with all the documents that set you up to do particular activities. You've got particular objectives, and those objectives, if they don't include your new activities, then you definitely should go back and chat to your lawyer about getting your documentation changed to make sure that you actually got the power as a board and as an organization to carry on those activities. And then from a tax perspective as well, one of the strict rules is that if you've got PBO status, you can't distribute your funds to any person other than in the course of doing a public benefit activity. And you've got to use your funds solely for the object for which it has been established. So when you got your PBO approval and possibly your 18A approval as well, you ticked certain boxes and you told SARS you were doing certain activities. So when you change your governing documents, you also need to go back to SARS as well and say, we're also doing these activities. And it might be that those new activities actually allow you Section 18A for those activities. So that might be an added bonus, but it's just very important to make sure that everything is in place for you to carry on these activities. Frequently asked question number 9, conditional donations. I've also come across a few of these examples during this time. And it's where, so here a donor is insisting I use a particular service provider to purchase certain items using the funds donated by him. What is the situation with conditional donations? So now it's absolutely fine if you want to, if you receive a donation from a donor and they say we would like you to spend it on that particular project or in that particular area. There's absolutely nothing wrong with that. Or you need to give us reports on impact. Those are all conditions, but they're not essential. And even I'm only giving you this donation if I can definitely get a Section 18A receipt for it and it's all valid. And if it's not, that's one of the clear reasons in the legislation where the donor can actually take their donation back. But we've seen a few instances here where they'll say, for example, say for example, it's an animal welfare organization and it's a pet food company, and they say we're willing to give you we're willing to, or maybe, yeah, so okay, that's a sort of a tricky example, but let's just say we're willing to give you a certain amount of money, but you must spend it at Absolute Pets, and we've actually got a share in Absolute Pets, but besides that, we would like, you can only get this donation of 100,000 Rand if you will go and you'll purchase food from Absolute Pets itself. So there's a direct and indirect benefit to the donor, and that's not allowed. So SARS is very, very clear. So where there's a donation that's got a direct or indirect benefit that goes back to the donor, you cannot issue them with a Section 18A receipt, and that threatens your vanilla PBO status as well. I had another interesting ethical question as well, which I'll change the facts a bit so it's not so sort of obvious, but where a supplier came along and said to the organization, I know of a donor who wants to make a big donation, but I'm only really going to tell you about that donor if you use me as a supplier. So it's not the donor getting any kind of direct or indirect benefit, it's the supplier, and it's sort of the ethical dilemmas of what is right there, what is right in that circumstance. It's not very nice of the supplier because hopefully they would want the organization to benefit from it anyway. And then lastly, what are the consequences of non-compliance? And I don't want you to walk out of your room at home today or wherever you are at the office saying, oh my word, we're in such trouble, we haven't been doing X, Y, and Z. What are the consequences? There are some severe consequences. You can have your approvals taken away. Whatever is not compliant can be treated as taxable income, and therefore there can be some tax payable. SARS, it might be that they nullify your Section 18A receipts as well. That's also a harsh possibility. But the truth of the matter is ignorance of the law is no excuse. This is a complex area of tax and of the law, and one's not expected to know it all, but I think one cannot avoid knowing the bare minimum about this, the bare minimum that allows you to ask the right questions and to know when you need to seek help. SARS in the legislation as well does say that they give you a period in most instances for corrective steps to be taken before they would take any of the drastic action that I've mentioned there. But if there is intentional non-compliance, then SARS has actually got powers to go against those people who have the fiduciary responsibility for the money of the organization effectively, and there is the potential for a jail sentence or a fine, but that's for intentional non-compliance. So I think where there's been inadvertent non-compliance, I think just seek to remedy it as soon as possible. Make sure that you've got all the structures and things in place for the future, that those mistakes aren't known again. Liaise with SARS. They're not looking to come down overly hard. They do usually give a period for the ability to correct anything that hasn't been done correctly in the past. So thank you. That's my talk section. I'm very open to answering any questions. I don't know if any have come in the meantime.